Yeah, so Tesla is usually the busiest single stock option, but it nearly doubled its volume today, and that meant that it represented close to 10% of all options volume, more than 15% actually of all single stock options volume.
Listen, this is no longer a growth company. It's an auto company. 86% of their revenues from selling cars, 98% of their gross profit from selling cars.
All that and more, so let's get to it. After the epic sell-off, Tesla trading about even today, doing a little bit of reconsolidation if you ask me. I personally went ahead and bought a couple more shares, and I'm contemplating an options contract. Do I bet Tesla's going to rise higher within the next week, or does it continue to skid? I've already missed the 60% train on my September 15th call option, but I have hope that it will gain steam.
Let's bring in Mike Coe, because he's going to break down this huge day of action. What happened here, Mike?
Yeah, so Tesla is usually the busiest single stock option, but it nearly doubled its volume today, and that meant that it represented close to 10% of all options volume, more than 15% actually of all single stock options volume. Calls did outpace puts by nearly 2-to-1, but I would describe the sentiment overall as fairly mixed. Now, if we exclude options that expire tomorrow, the next busiest contract were the September 400 calls, believe it or not. 85,000 or so of those were trading for just under $1.25 a contract. And my guess would be that this is just market participants who have a fear of missing out in the event that it does somehow miraculously rebound to those late 21 highs.
Woo-wee! Let Tesla hit 400 by September. Your boy is gonna be laughing all the way to the bank. But on a more serious note, I'm not so sure that Tesla can hit that within the next 6 weeks. Those $400 calls to me are like lottery tickets. They don't cost you much, but if you hit, can increase your capital almost tenfold. This level of optimism is making me feel a little less shit about not selling it when the stock reached $298. A little. Before we go any further, I'd like to take a look at Morningstar's analytical update for Tesla after their Q2 earnings report. Not much has changed. I'm pretty sure they had a 2-star rating prior to the Q2 earnings report. That remains unchanged. 2-star just means that they think there's other places in the market you could put your money and probably get a better reward. Not saying that they don't think Tesla's a good company, it's just they probably think there are other places in the market you could go. At the date of this publication, Tesla was at a mighty 291, a market cap of over $900 billion, knocking on the door to being a $1 trillion company once again. We have content that has changed on the left, highlighted in light blue over there. Now, Morningstar is a bit of a mixed bag. That's why I like using them. They have some bullish ideas in their notes, yet they have a significant amount of bearish takes sprinkled on in there. Highlighted in green are what I believe Morningstar has on point, while the pink version of what's highlighted probably needs some work. Tesla earnings. Profit margins contract for a third straight time, driven by price cuts. Seth Goldstein writes, "We maintain our $215 per share fair value estimate and narrow moat rating for Tesla following the company's second quarter earnings. At current prices, we view Tesla shares as overvalued, with the stock trading in 2-star territory." In response to slowing demand, Tesla began cutting prices in the fourth quarter of 2020 and has continued throughout the first half of this year, leading to 3 straight quarters of lower average selling prices and lower automotive gross profit margins. While this is true, this is nothing new. This is what Tesla intends to do according to their secret master plan. We think the company is likely to cut prices in the second half of the year in response to other automakers also cutting prices, which would result in further margin declines. Accordingly, we reduce our 2023 automotive gross profit assumption. I wonder how low. However, we think prices will begin to stabilize by the end of the year as economic conditions improve, leading to 2023 being the cyclical low for margins. During the earnings call, management highlighted the launch of the company's first pickup truck, aptly named Cybertruck. Over the long term, we see the vehicle having a relatively modest contribution to total deliveries, as we forecast a peak of around 100,000 vehicles per year, well short of management's 250,000 target. Bet against Elon if you want. However, the truck aims to show off Tesla's new technology, which we view as crucial to Tesla's brand, which is producing vehicles with the best technology. Additionally, Tesla began production of its Dojo supercomputer. This aims to train Tesla's autonomous driving software, which should allow the company to develop faster improvements and accelerate the timeline for the full launch. The full self-driving software should allow Tesla's vehicles to have a third ancillary revenue stream in addition to charging and insurance, which boosts the value of each car sold, to Tesla over the long run. This isn't highlighted in light blue, but it is something worth noting. Morningstar at least gives credit to Tesla for their full self-driving software. What the bulls have to say. Tesla has the potential to disrupt the automotive and power generation industries with its technology for EVs, AVs, batteries, and solar generation systems. Tesla will see higher profit margins as it reduces unit production costs over the next several years. Through the combination of Tesla's industry-leading technology and its unique supercharging network, the company's EVs offer the best function of any on the market, which should help Tesla maintain its market leader status as EV adoption increases. That is the bull thesis in a nutshell. EVs are taking over. If you produce the best EVs, you will have the lion's share of the market, which will undoubtedly lead to more financial opportunities in the future. What the bears say. Traditional automakers and new entrants are investing heavily in EV development, which will result in Tesla seeing a deceleration in sales growth and being forced to cut prices due to increased competition, eroding profit margins. Tesla's reliance on batteries made in China for its lower-priced Model 3 vehicles will hurt sales as these autos will not qualify for US subsidies. Solar panel and battery prices will decline faster than Tesla can reduce costs, resulting in little to no profits for the energy generation and storage business. Obviously, I disagree with all of that. Starting with the competition side, there are other EVs on the market. They just don't sell as much as Tesla does because they're inferior. Now that's not to say that another EV won't come along and be just as good as a Tesla, but I would like to direct your focus to that of the smartphone industry. First mover advantage clearly goes to Apple. Now while there are other phones in the market that are just as good, if not better, Apple still maintains an epic level of market share. Why do you ask? It's because the software, the user interface of their products. Tesla is a computer on wheels, just like the iPhone is a computer that can receive and make calls. Sure, there will be others, but the best will rise to the top. And Tesla is winning on all fronts when you look at the battery electric vehicle space. This is something they have in common with the Apple products. I hate to say this, but the bear arguments are weak. What drives Morningstar's price targets, you ask? Well, let's check it out. Our fair value estimate is $215 per share. A little weak in my opinion, but higher than others. However, due to price cuts far exceeding cost savings, we forecast automotive gross margin contraction in 2023 to 19% from 29% achieved in 2022. 19% is not a terrible number. In my bear case, I have Tesla at 15% gross automotive margin, and my price target is significantly higher than $215. Long term, we assume Tesla delivers around 5 million vehicles per year in 2030. Well, I guess this is where we differ. 5 million is just a quarter of what Tesla's own projected estimates are. We forecast segment gross margins will expand to roughly 31% from 29% level achieved in 2022, generating automotive profit growth in excess of revenue growth. Now the rationale here seems that if Tesla is only able to produce 5 million vehicles a year in 2030, they're probably able to sell them at a premium. But I hate to tell you this, the average selling price of Tesla's vehicles is coming down dramatically by 2030. That's how they're going to be able to sell 20 million vehicles in the year of 2030. Average selling price is going to be somewhere probably around $23,000 if I had to make a guess. And this gross automotive margin may be a bit too high. As a result, we forecast company-wide operating margins will reach 20% by the end of the decade, up from 17% in 2022. My own number's a little bit higher than this. I got their operating margins somewhere closer to 28 to 30% by the end of the decade. To fund this growth, we assume Tesla will need to spend over $100 billion in capital expenditures over the next decade. Our base case also adds the present value of Tesla's autonomous vehicle ride-hailing robotaxi business, which accounts for roughly 7% of the total valuation. This figure assumes Tesla captures a 2.5% market share across the combined market of the US, EU, and China. Finally, we add the present value of Dojo's AI training services and the present value of humanoid robot sales, which accounts for less than 1% of our total valuation combined. Kudos to Morningstar for even entertaining it. Our downside fair value estimate is $90 per share, while our upside scenario fair value estimate is $420 per share. Nice. In our upside scenario, we assume Tesla delivers around 10 million vehicles per year by 2030. That is only half of what Tesla themselves anticipates that they will do by the year 2030. Tesla's going to blow through their bull case estimate. Instead of 420, very well could be 4,200.
Back to Trading 360. It's time for the 360 round, all about Tesla. It's had its deliveries. They're still shooting for 1.8 million this year. Within the report, there were a lot of good things to discuss. And I guess when we talk to our bear here, he'll tell us some of the uncertainties. Hatem Diab, this is a bull-bear debate. Hatem Diab, managing partner, Gerber Kawasaki Wealth and Investment Management. Gordon Johnson, CEO, founder, GLJ Research. Thank you both for being with us. Hatem, you've been on with us so many times. You always say, don't bet against Elon. While you don't give exact price targets, you certainly give the trend, and that is that you're a believer in Tesla and its stock. In the meantime, Gordon has basically a $24 target and a sell rating. So Gordon, hold on. Hatem Diab, what did you like about Tesla and why do you see this growing?
Hey, Nicole, thank you for having me. Listen, it was a great report. They've reached $25 billion in revenue, almost at least. So they're like a $100 billion run rate. That's a very exclusive club to be on. Margins are good. I expected them to be a little bit less, but they came in at 18%, so that's also very good. And really, they're growing fantastically well, almost 50% top line. So I don't know what's bad in this report.
Okay, so the first thing that Gordon's going to say is about the margins. And Gordon, keep it short so we can have a nice discussion. Go ahead, Gordon, and let's hear your thoughts.
Damn! Already! Shots fired! Keep it short, Gordon. We know you got a lot to say, and most of it is dead wrong.
All right, so I think where the bulls are dead wrong is in the auto industry, you had a temporary chip and supply chain issue where you had shortages in 2021 and 2022. We know that used cars are selling for more than new cars, right, which is an anomaly. And that allowed Tesla, who was willing to cut corners on chips, CNBC did a spread on this, to have artificially high margins. Now their margins are regressing back towards the mean. Their operating margins were 24% in the first quarter of 2022. They were 9.6% last night, down from 11.8% in Q1. So it's just not the company that people thought it is. Their earnings profile is much lower, and they're still cutting prices. So that's the problem, and I think that's the story for Tesla in 2023.
Look, I mean, at this point, yes, the valuation certainly seems very high. The prices they cut, Ford has been cutting prices, but they are creeping a little back higher. Hatem, let's kick it off. What is it about Gordon, what he's been saying? I mean, we know that the factories, he said, Elon Musk said that in the third quarter, production may be down because they've been doing some factory upgrades. You really like what they've been doing in Berlin and Austin, for example, Hatem?
First of all, the margins are going down because Tesla is investing heavily in its growth. I think that you want a company that is a growth company to be investing and really creating new products and batteries and chips. They just filed in Berlin for a new plant that's going to manufacture over 1 million cars in Europe. So if you think about that, currently Berlin does, 200,000 cars. So I think the growth potential there is really tremendous. And as far as what Gordon said about the chips, Tesla is also investing, they said, I think, over $1 billion in their dojo and their chip manufacturing. So from an AI perspective, it's probably the only company that really has a true AI or solution for self-driving car that is really sustainable and that will continue for a long time.
And so, Gordon, I know that you're not so trusting on the chips. You've also often said that you're not even a believer in the fact that they are making batteries. You don't believe really in the self-driving, right?
Well, they're making batteries, but everything they said at Battery Day, we now know is a farce. Listen, when people at Gerber Kawasaki don't have models, they don't understand what's going on. Tesla's other income was a $370 million benefit this quarter to the bottom line.
Has or doesn't have?
The quarter, they would have missed numbers. If you look above the other income line, their operating income was down 3% quarter over quarter, 10% year over year. Listen, this is no longer a growth company. It's an auto company. 86% of their revenues from selling cars, 98% of their gross profit from selling cars. What auto companies have to do is cut the price to move units. 2,000 auto companies, Warren Buffett made this point, 2,000 auto companies emerged in 1905. Nearly all of them went bankrupt. Right? Why? Because it's highly intensely competitive, high capital intensity, And Tesla is being shown to be an auto company. And no matter what Gerber Kawasaki says with respect to how great they love the company, margins are collapsing. They're going to continue to collapse. And the reason why they produce more cars than they've sold now for a record 5 straight quarters in a row, and their production is going to be down in Q3 is because they have a demand problem. They're getting crushed in China, market share 30% to 11%. They're getting crushed in Europe, market share from 30% to 15%, and their market share is falling in the EU. And again, now that we don't have supply chain issues, they're suffering.
Okay. Let me jump in here because the first thing is I'm going to say is how do you know what models Gerber Kawasaki has and does not have? That is you can't assume anything like that. However, I'll
hit them with the mute button.
Let that go and say, look, when you talk about market share, Hatem, there's no question that the competition has been increasing. Do you think that they can continue to be the leader that they are? Look, there are many people who think it's overvalued, but does $24 price target and a sell rating seem ridiculous to you?
Thank you for saying that, Nicole. I don't know what Gordon is talking about models. I don't think I need to showcase any kind of our models. But ultimately, what Gordon is looking at is completely wrong. What Tesla is trying to do is trying to go after the whole car market, not just the EV market, and that's only 6 or 7% currently of the 15 million cars that we sell in the United States, or 100 million globally. So if Tesla has 60% of that market, but that market itself is growing, so we don't need Tesla to have 70% of the whole market. So I think what's missing here is the fact that Tesla, the Model Y, has been really the top-selling car basically everywhere. So the growth story here is really just getting started, and they have the best battery technology. They have the best software, so they're really the top dog no matter how you look at it.
Okay. Gordon, Cybertruck is going to be produced in high volume next year. Final thoughts here, Gordon.
So we don't know if it's going to be produced in high volume, right? It's 3 years late. They were supposed to be producing high volume this year. Now they should have next year. But I just want to highlight something he said when he says they lead everywhere and they lead in batteries. That's just not true. They don't lead in China. That's BYD. They don't lead in Europe. That's VW. And now you have Ford and GM coming. With respect to, the final thoughts, look, Elon Musk is telling you they're going to produce less this quarter, right? That's a big problem. And he's telling you they're going to continue cutting prices, which they've done. You don't cut prices. CarGurus has Tesla's prices down 35% over the past year. The average car is down 5%. GM's down 1%. Ford is up 1%. So they're cutting prices far more than the competition. The reason is because people don't want to buy their cars. They have 1.67% share globally, 4.4% share in the U.S. This isn't a leader. They are a laggard.
Okay, you had to tell them about the margin that you were looking at, the X-Auto margin, quickly.
I mean, 18%. Come on, Gordon. What are you talking about, buddy?
Gross margins of automakers. They sell direct to the customers, which means their discounts are in SG&A, whereas other automakers' discounts are in gross margins. Look at the operating margin. They are lagging.
Gordon, $24. $24. Come on, Gordon. $24.
It's going to get there. When it does, we'll have you on the second graph.
Come on. $24, Hatem?
I mean, it's silly. I mean, the company's doing $100 billion in sales and 18% margins. Come on.
They're just roasting poor Gordon. The internet will never forget this, and he's right. If Tesla does drop to $24, they'll have him on, they'll throw a ticker tape parade, but the man's been wrong the entire existence of the company.
Where's the real value of, where should it really be, Hatem?
Listen, they're a software company. We haven't seen what the potential is of full self-driving. We haven't seen what the potential of this AI revolution. They're spending a lot of money in there. The Cybertruck, yes, they're not going to produce a lot of them, but this is going to be also another top product. I think they're going to sell hundreds of thousands of it, and ultimately this will own 20% of the whole car market.
Okay, let's leave it right there. I like the bull bear debate. Thank you both very much.
Despite the recent slide of Tesla stock, the anchor has trouble stomaching the price target of Gordon Johnson, aiming for $24 per share when it comes to Tesla stock. It's absurd, but no one defends the bear case better than Gordon Johnson. His conviction is amazing. Dead wrong, but amazing nonetheless. In conclusion, Tesla stock's doing a little bit of reconsolidation. Tesla is experiencing an influx of option activity, especially expiring in the September timeframe. More bullish than bearish, mind you. Morningstar gives us a mixed bag of bullish and bearish notes after the Q2 earnings report, and the bear-bull debate for Tesla rages on as Gordon Johnson is willing to step into the ring with any Tesla bull. Sorry to say, Gordon, but you lost today. That's all I got for you. Be easy. Peace.